Hello, my friends, wherever you may find yourself in time and space. If you've been watching financial news or really any news in the past year, and especially in the past few months, you've heard about cryptocurrencies and stable coins and this thing called DeFi or decentralized finance. Now we all have this burning question. Is this crypto stuff the future of finance, or is it a fad, or is it some form of new financial scam? To help make sense of all of this, I've invited DeFi expert and LinkedIn learning instructor Kedric van der Carr onto this conversation. So, Kedric, why don't you introduce yourself?
Thanks very much, Morten. Good to be here. I appreciate the opportunity to come and talk. So kind of my background is have been in the cryptocurrency and blockchain space for several years. I've started multiple projects and companies in the space. I have a course called DeFi Masterclass, which is a live cohort-based learning, teaches people about decentralized finance, as well as a different business that called Boss Financial, which teaches people how to yield farm, which is, I'm sure, something we'll talk about in just a moment here. And most recently, I launched a hedge fund called Coinium, which is specifically focused on utilizing yield farming in order to be able to earn returns for our investors. So that's a little bit of background on myself. But yeah, excited to have a conversation today about this stuff.
Okay, so there were about like 200 terms in that intro.
Yeah,
and
exactly.
I think as we start this conversation, it's important to just establish some baseline terms so people understand what we're talking about. So let's start with the top one, which is this decentralized finance or DeFi.
Yeah.
Can you briefly explain what that is, and especially in contrast to, I guess, what would be referred to as centralized finance, which would be the difference?
Yeah, exactly. Yeah, so decentralized finance is you can think of it almost like a parallel financial system that's being built right now, where we're using smart contracts, which are pieces of code that execute on the blockchain in order to be able to replicate the operations that are typically performed by banks. And ultimately what this does is it allows for new types of financial products to be built, as well as replicating existing financial infrastructure that already is in place in traditional finance. And there's, you can do all kinds of things in decentralized finance. You can get loans, you can have savings accounts, you can get insurance, you can even start a hedge fund, all on the blockchain. And you can think of it sort of like we're removing the middleman and replacing the middleman, which has traditionally been big banks, or replacing it with smart contracts living on the blockchain. And this, why this is so interesting, is when you do that, when you remove the middleman, what it does is it opens up all the business models that big banks typically had access to. And so, the analogy I like to use is, if you think of big banks as being a piñata, then DeFi or decentralized finance is a bat that just split open the piñata, and falling out of the piñata are all these business models that, again, have only been accessible to large financial institutions. Now, folks like you and me can go out and actually profit from those same business models. And it turns out banking business models tend to be pretty profitable.
Right. So in the traditional banking system or the traditional financial system, if I have money and I want to invest it, I would hand that money over to an entity, whether that be a bank or it be an insurance agent or it be some form of financial advisor. They would then put it into the system and manage it for me. And then there are levels of involvement. Like you can go all the way down to like day trading, where you're actually doing it, but you're still operating through some form of centralized system that holds the accountability of what is happening. Let's focus in on that decentralized part of this name. Like, what does it mean when someone say this is a decentralized system?
It's peer-to-peer. That's the easiest way to describe it. And I think you're hitting on a really interesting, really important point, which is the fact that in decentralized finance, we are self-custodying all these assets. Sorry.
I think you have a phone call.
My mom was really calling right now. Yeah. So in decentralized finance, we're self-custodying, which means that we are not turning our funds over to a financial institution in order to be able to do those actions. We're controlling our own assets here in this space, which has a lot of benefits and drawbacks, right? So there's no customer service line for me to call in decentralized finance. But in exchange for that hassle of having to deal with your own money, we have the opportunity to earn returns that are in orders of magnitude higher than what we can see in traditional finance.
Right.
And so we get these higher risk-adjusted returns in exchange for kind of doing this ourselves and sort of taking control back from traditional finance.
Right. So you're, in a way, it's kind of trading safety for control.
Yeah,
suggesting.
Exactly. Yeah, there's if I turn my money over to JP Morgan, conceivably they're on the hook if they do something to lose it. Conceivably, like doesn't always work out that way, but in theory that should be the case.
Yes.
In decentralized finance, I am solely responsible for my assets, and so again, if something goes wrong, it's on me, and so. That being said, in spite of that, right, decentralized finance has exploded over the last several years because of the fact that, again, risk-adjusted returns in this space are substantially higher than what we see in traditional finance.
Right. In that context, there's also this question of what type of regulations exist in the space, because a lot of what is happening in the financial sector, so whether it be banking or insurance or any kind of investment, is heavily regulated by governments to ensure that malfeasance doesn't take place. Everything from like rampant money laundering and financing criminal organizations, all the way down to the banks or financial institutions doing things that are incorrect or illegal or doing things that are harming the customer.
Yeah.
So in a decentralized system, where everything is peer-to-peer, how do you ensure that that kind of activity doesn't take place?
Yeah, and in decentralized finance, obviously you have to worry about scams, and that's a whole different conversation that is worth having. There is not clear regulatory oversight of the decentralized finance space as of yet. Likely that will change in the future, but as of right now, that's not the case. We know what happens in centralized finance, right? We know what happens. We know how that industry works. We've had it for a long time, and ultimately, I would propose that is an inferior system, and ultimately has led to some major systemic problems in the world, specifically the wealth gap. Right? We have this, our existing incumbent system has allowed for a massive disparity when it comes to the distribution of wealth in the economy. Banks make a ton of money. Wealthy people make a ton of money. And under the kind of guise of consumer protection, a lot of substantial wealth building type assets are not easily accessible to the average person. And so ultimately we have the situation where we have the rich getting richer and middle class and poor getting left behind. Now there's only so long that will last until there's, that represents an existential threat to society. And so we need technology to figure something else out, because we can't keep going down this path. There is a point where people will rise up, and I don't want to sound like a crazy person, but like we have examples in history of if you have a bunch of poor people who are getting screwed, they're not going to stand for that for long. And so the only way, I don't believe that government redistribution is an effective method to handle that. I think it has to be solved with technology. The only idea that I've heard of is crypto and DeFi /Web3. So that's why I think this is a really important, and again, there's problems to it. And with any technology, it's not inherently good. It's what we make it, right? And so the people who are working on this have to be very deliberate about how we do it.
Right.
If we don't screw this up, I think it can genuinely help a lot of people.
Yeah, because when you describe this, my immediate thought is you're describing lack of regulation, like the wealth inequality, the inequity in access. All those things are regulation problems, and the reason why we don't have regulations is because the politicians that make these decisions are in the pocket of those rich people. Throwing technology at a regulation problem doesn't solve the problem. It just shifts the problem to a different space. And especially if you're introducing a space that has no regulation, it's unlikely to solve that problem. And I mean, I should be clear. I should have been clear up front. I am beyond a crypto skeptic. I think that this entire crypto space is in some ways some new form of scam that we just haven't seen before, that is built around technology, and it looks shiny and a lot of people are making a lot of money on it. A lot more people are losing all their money in it. So I need to make that clear as we have this conversation so people who watch it understand where I'm coming from. There's an underlying message here that you said, that like technology can get us out of this problem. But the people that are funding these things are the same technologists who are currently building enormous wealth off the existing system, right? The money that's coming into the space in terms of development is coming from the same venture capitalists who are currently taking all the money out of the other systems. And they wouldn't be investing in this until they saw the ability to take the same amount of money out of this system. They're not going, oh, now that we've become filthy rich off the inequities of a system, we're going to funnel our money into a system that takes away that inequity and makes us less rich. That does not fly. That's not how the world works. So how do you make those two pieces go together?
Well, I think there's a good bit of nuance here that's really important. So yes, I let's say this. I don't believe that the source of funds, I agree, like, there's a lot of venture capitalists who made a lot of money in the traditional system who are funneling money into this new system. But just because they're the source of funds doesn't mean that they can actually ultimately control the directionality of this. Ultimately, this is a decentralization of value creation. What I mean by that is we are self-custodying assets, and we have the opportunity now to be able to participate in the economy and add value in ways. Now, does that mean that there's going to be people from traditional finance or the incumbent financial institutions that make money? Of course they will. But that doesn't, the fact that they're investing in this and will make money from it doesn't negate the fact that ultimately what's happening right now is we're looking at a decentralization of power, right? And in my opinion, that has historically been a good thing for society, right? So democracy, right? So the idea that individuals can affect the powers that control them. Mm-hmm. That is happening here, except it's happening with our money. There's all kinds of problems with it, and we have this massive information asymmetry that causes scams and causes all kinds of problems. But ultimately, what we're going for, what we're shooting for, is the ability for an individual to be able to contribute to the economy beyond just trading their time, right? In the existing system, the average person can only really make money by trading their time in a job, right? In this new system, we have the ability to actually start allowing for people to contribute in ways beyond just their time, whatever it is. And we can talk about examples of what that might actually turn out to be in the future. But that's why I think it's so important is the individual is ultimately sovereign in decentralized finance and Web3. And that fact is not negated by the original capital sources which funded this, right? It's just that the venture capitalists see an opportunity to make money, and they're going to try to make money, which is fine. And ultimately that's helping go down this path. But It doesn't change the key aspect, which is we're trying to give economic power back to the individual, right?
Yeah, I guess the thing that doesn't register the same way in my brain as it does in yours is this idea that of the power being given back. Because what I'm seeing is, here's a way that you can put your money in a high risk environment that you couldn't do before. That is not power. That is just a way of risking your money that without protections. And it makes sense if you have a lot of money to do that, because then you have a lot of money that you can lose. But if you don't have a lot of money, then that is an extremely high risk endeavor with no safety net, right? And no accountability other than yourself. So like the self-sovereign idea makes sense if you have a certain political mindset about how the world works. But for a person who lives paycheck to paycheck, this doesn't provide any leverage in the market that they don't already have, or like it provides leverage only if you're willing to gamble money into a system, right?
Yeah. Well, what I'll say is this: that your point right there is predicated on the idea that you have to contribute money in order to be able to participate. And in Web3, I don't believe that'll be the case. I believe there's ways for you to be able to add value without actually having to risk your capital to do so. Okay, so and this is obviously getting into more Web3 stuff, right? So decentralized finance, I'd agree, it's typically predicated on you investing some amount of money in order to be able to participate. Fine. Web3, which is DeFi is ultimately a subset of Web3. Is actually allowing for people to potentially participate in ways without having to risk their capital, but still be able to earn money from it, right? So I think it's just a key nuance that I just want to call out.
Right. So this links to thing that you mentioned in your intro, this idea of yield farming, which is what you're covering in your new LinkedIn Learning course that I watched last night because I thought it was very interesting to just get all this stuff. So can you explain? You need a whole course to explain this because it is quite complex. But can you kind of give a Cole's Note version of what yield farming is? Because it's a thing that, if an average person wouldn't touch this kind of thing before, so it's a new concept for people.
Yeah, So, well, you remember what I mentioned earlier about how DeFi breaks open big banks and all these different business models start falling out and allows for us to be able to start accessing those. Yield farming, well, there's different ways to be able to earn yield in decentralized finance, but one of the primary ways is by providing liquidity, or in traditional finance, this is known as being a market maker. What that means is you put up some capital into a pool of money, which allows for any buyers that want to buy or sell a given cryptocurrency, they can use that pool of money in order to be able to trade their tokens, right? And so for providing that valuable service, which is a critical service in any industry, but especially in crypto, you earn fees, trading fees based off of that. And so the easiest way to think about yield farming is it's market making. And again, that's an industry that's been around for hundreds of years. And again, it's just market making is just whenever, and there's market makers for all kinds of industries in traditional finance, right? There's market makers for gold and oil and wheat. And whenever a buyer wants to buy or a seller wants to sell, the market maker will allow and facilitate that transaction. They take a small spread of all the transactions that go through. Turns out that's actually a very, very profitable business model. And so yield farming, again, there's multiple ways to earn yield, but the primary example would be, in my opinion, would be effectively market making and providing that service. And so it's that's a service that's valuable and will continue to be valuable in perpetuity.
Right. So it's sort of like lending money into the system and then let other people use the money to do things with it, right? And if you want to dumb it down to a super basic explanation.
I would, although I'm hesitant to use the word lend, because there is the ability to also lend your cryptocurrency out to others and earn yield in that way as well. So it is, although you are taking money and depositing it, it's the nuance here is the fact that I can remove my liquidity or the money that I put into the system at any time. With lending, I might be locked up, or my funds might be in some other person's hands, and I'm not able to remove it as quickly. It's nuanced, but I think
no, I get it. It's sort of, you're putting money into the system and letting the money work for you, essentially, right?
yes,
And then,
yeah,
and then garnishing some form of revenue based on the fact that your money is working, because you're lending, or sorry, you're putting money into a system that needs to have more money in the system, right?
Yeah, it's kind of like like the penny tray at the gas station, where you put your money in there, and some people take it and some people put in there. It's a shitty example, but it's not the worst one in the world.
It's examples like that are necessary for people to get some form of hook to hang knowledge on. So that is an actual good example. Just before we continue, if you're watching this live, you can use the comment field to ask us questions, because that's one of the cool things about having live events, that you can actually ask questions. And I know there are questions about this. So if you want to get some specific thing answered, by all means, ask us. All right, so we talked about what DeFi is and what this yield farming thing is. And I want to kind of step back a little bit and talk about this space, because if, like, in the news right now, everyone's talking about, like, there's the crypto crash and the crypto winter, and there's stories of people who are there saying that this is the right time to put money into it, or this is the wrong time to put money into it. And then there's the whole thing about stable coins, whether they're stable, and tokens, and altcoins, and Bitcoin, and Ethereum. Like, there's so many pieces to this puzzle. And when you're talking about DeFi, to my understanding, what you're talking about is taking the more base values within the system, which are either stable coins or something like Bitcoin or Ethereum, and using the relatively secure value within those assets to fund these other things that are often referred to as altcoins, right?
Yes, but not necessarily always, right? So,
Okay.
And again, it's depends on what exactly we're talking about. But like when you provide liquidity, right? You're acting like a market maker. You're yield farming. Oftentimes, what you have to do is you have to own two tokens. And it could be any number of tokens, right? I could provide liquidity for Ethereum and US dollar coin, which is a high quality stable coin, or USDC. And my returns for providing liquidity, so that means I have half my money in one, half my money in the other. My returns for that are very good. But if I take on more risk and I have, let's say, a pairing of Ethereum and let's say some new altcoin that doesn't have the history, doesn't have the market cap, doesn't have the track record, then my returns are much higher. And ultimately, the reason behind that is as a yield farmer, I can achieve returns across a whole spectrum of different assets that I want to hold, right? So if I want to hold just stable coins, I can go out and earn returns there. And my returns are going to be commensurate to the amount of risk I'm taking on. So if I'm holding stable coins, especially high quality stable coins, then I'm going to have a certain return profile. If I start to layer in risk, like I have, a stable coin paired with, let's say, Ethereum, which can fluctuate in value, then I'm going to have a different return. And if I want to go, full degen or full degenerate, and I want to, own or provide liquidity for a very new, very risky token, then my returns are even higher than that. And so what's interesting is what happens when you can actually blend your return profiles across a mixture of assets, and ultimately begin to diversify your portfolio. And that's where I think that the magic really happens, and the real potential of returns, are seen.
Right. So Julie has a question that closely relates to this. This Bitcoin investing is affected by the daily market value, correct? And I think this is a good opportunity to explain the difference between Bitcoin and Ethereum and this thing called stablecoins, right? Because that's where this market value thing comes into play. So can you explain that? Like, what is a stable coin and how is it different from Bitcoin or Ethereum or one of these other things?
Yeah. So there's lots and lots of different types of stable coins, right? Some that are very risky, some that are, in my opinion, very secure, and sort of everything in between. Stable coins are just coins that are designed to be pegged to the value of some typically external asset. So oftentimes, when you talk about stable coins, you're talking about like a coin that's supposed to be pegged to the value of a US dollar. Now, there's different ways that pairing is, or that peg is trying to be maintained. You have fiat collateralized stablecoins, which is like US dollar coin, where you have effectively a US dollar sitting in a bank account backing up every single token that is in market. And then on the other side of the spectrum, you have algorithmic stablecoins like UST, which is trying to leverage oftentimes some arbitrage mechanics in order to try to maintain its peg. And that historically has failed miserably.
Right.
And so UST would be an example of that. And then kind of everything in between. You have also kind of in the middle, you have crypto collateralized stablecoins, where you have a stablecoin that's over collateralized, or there's more value in a non-related cryptocurrency. So the best example of this would be like DAI. DAI. DAI is backed by Ethereum, as well as US dollar coin. But for purpose of the example, it's backed by Ethereum, and effectively it's over collateralized. Means that I need to have more value in Ethereum for every DAI that I mint. So typically like 50% more value. And ultimately, what that means is if Ethereum drops, and my stablecoin is still backed, but it might get, my positions might get liquidated, or be able to make sure that it maintains the peg. And so again, there's lots of different types of stable coins. In this market environment, I'd recommend probably sticking to fiat collateralized stable coins, or DAI. DAI is pretty good quality. But again, not financial advice. We should probably call it. Nothing is financial advice. Advisor, so full disclosures, full disclaimers.
We're just hypothetically talking about things that exist in the world, and then
Exactly.
people can make their own decisions, right?
Exactly.
Yeah, but that is important to understand, that there's this, yes, all of these things are affected by markets, because everything that's in a market is tied to money is affected by the markets. Like, so, you see that if the markets go up, the markets go up for everything. If the markets go down, the markets go down for everything. And this DeFi system and cryptocurrencies are intrinsically linked with the regular financial markets. Otherwise, it would have no purpose. But the difference between, say, Bitcoin and Ethereum, which is its own currency effectively, and stablecoins, which are pegged as in like supposedly nailed to some external value, is that the stablecoins aren't supposed to fluctuate in value. And yes. I say they aren't supposed to because we've seen in recent months that sometimes these things go horrendously wrong, like the Terra Luna situation, where the stablecoin effectively went to zero and all the money just vanished. Which is, but that's what you were talking about, right? That if, depending on what the collateral for the stablecoin is, or what it's pegged to, the value will fluctuate and the risk increases. Because that was an algorithmic stablecoin, correct? The Terra Luna situation.
Exactly. Yeah, and it's again, the nuance is really important, because ultimately the mechanics about how it's trying to maintain its peg is the devil's in the details, right? And so we have not seen a highly distributed algorithmic stablecoin be successful yet, and it's not clear that it's possible. It might be it might be like a perpetual motion machine type thing, and so we're other people are going to try, and these experiments and what happened to UST is absolutely awful, because there's a lot of people who are relying on that being a stable coin, and thought that was supposed to be pegged to the dollar, and they lost everything. And so, this is a very, very unfortunate consequence of the fact that this is still the Wild West. And I firmly believe, though, that these experiments are important and ultimately will lead to innovation around financial products that just we haven't seen happen before. And ultimately, that's, in my opinion, a good thing.
Right. So there's another question here from John. Well, maybe it's sort of like a statement question, those fancy ones. Quantum computing, mining, lower cost individual access and control should increase sovereignty. Yes?
Okay, let's break this down, because there's
let's break it down. Can we start at the end and say sovereignty? Because that is a term that is coming up more and more in the crypto.
It is, yes. So okay, so I'm just reading through. So quantum computing, let me save that one for the last. Mining, lower cost individual access control should increase sovereignty. Yes, lower cost access is core to what we're trying to achieve here, right? So as we can see, education is really important in this space. But theoretically, right, if we can get education pushed out to a wide swath of world population, then really what's needed to be able to get access to this space is some relatively basic technology, right? Internet access, mobile device or computer. And that would allow for, in theory, a whole new group of individuals to be able to join this financial system, right? So the unbanked population is, as of 2017, was 1.7 billion people. And so, we have this, and ultimately banking access to banking is a necessary tool in order to be able to participate and make money in the 21st century. And so first and foremost, this gives potential access to a much larger group of people. That's a good thing. That's a very good thing. And so, yes, I think that would certainly increase sovereignty and increase benefit to the world. Mining. So the idea here is mining, which is talking about utilizing proof of work, or effectively, oftentimes this is the example is Bitcoin, right? So with Bitcoin mining, we're using computers that are burning electricity in order to be able to secure the blockchain, and for that, those computers get paid rewards. Mining, in theory, could be accessible to anybody, and Block, or Jack Dorsey and Cathie Wood at ARK Invest are very strongly advancing this idea, this concept that, hey, let's use Bitcoin mining in order to be able to advance or try to increase proliferation of renewable energy. The idea here is, if I've got solar power panels on my house, once my battery's charged up, why don't I just turn on my Bitcoin miner and allow that to start securing the blockchain and earning income? And so, it's a really fascinating thing that they're pushing very hard to try to advance right now, and that's super interesting. Again, giving access to other ways to make money beyond just trading your time. So yes, that increases sovereignty. Quantum computing. This is I don't immediately see the connection. I think quantum computing, oftentimes when it's referred to with cryptocurrencies, people look at that as like an existential threat to, if you have quantum computers, can that just, hack the blockchain and cause all kinds of problems? There's ways to be able to counter that. So I don't believe quantum computing will. I think that there's ways for algorithms to adjust in order to be able to function in a quantum computing world. But that's the only one that it's not clear how that will increase individual sovereignty. But John, if you, I'm very curious. You know, you're welcome to kind of chime in. I'd love to learn kind of how you're thinking about how quantum computing might increase individual sovereignty.
Yeah, I have to say, my immediate thought to counter quantum computing in this space, beyond the whole, we're still not sure quantum computing is ever going to work, and it's, you know, it's still like a hypothetical future technology very much. But it's funny because I've heard crypto people talk about quantum computing in both directions here. One is saying that quantum computing could potentially corrupt blockchains or make blockchains so unstable that it would be impossible to run them, these distributed blockchains. But then on the other side, there's this idea that you can use quantum computing to make hacking the blockchains impossible, because the quantum computers can add a security layer on top that, because it's generated by a quantum computer, you would need a more powerful quantum computer to breach it, right? So but it's very much like in the future, where we have this technology that we haven't quite defined yet, but we are going to put under the umbrella quantum computing, things will be possible, right? Which is a fun thought experiment. But it's, until we have something beyond like very, very basic experiments that call themselves quantum computing, it's hard to say what that's going to be. But I find this conversation around sovereignty and the unbanked very interesting in this context, because it's something you often hear from the crypto community, this idea that this new blockchain-based technology will give people access to financial instruments they don't currently have access to. And then on the other side, you have people who are saying that there are reasons why those people don't currently have access to those financial interests, and giving them another tool doesn't solve those problems. Like, the problems here have to do with other concerns that are outside of that. For example, like you said, lack of stable internet access, lack of sufficient funds to be able to do this. I mean, you live in the United States, right?
I do.
Yeah, and I live in Canada, and we both live in countries where you have these these money mart type things, where you go, like, you get your paycheck, a physical paper check, and then you go to this extremely exploitative system that takes like 20% to give you money. And the reason why that exists is because a lot of people don't have a bank account. So when we talk about the unbanked, that is one aspect of it. There are people that don't have a bank account, and because of that, there's this extortion system built around it that takes a huge portion of their money. So let's take that as an example. You are one of those people who gets a paycheck but doesn't have a bank account. How does this crypto space help you?
And there's actually some technologies, and I've been advising a company that's been working on this exact problem. There's technologies that are being built, which allows for people to take, and in your particular example, they have a check that they need to be able to turn into some sort of digital version of money in order to be able to participate. Let me table that exact example for a second and even go a little bit more extreme. What if you have somebody that only has access to cash? And so there's companies being built right now which are, and Coink is an example of one that I think is really cool, really interesting technology, that they're allowing for people to, they're essentially building these kiosks which allow people to deposit change or paper money into the kiosk. And it requires a mobile device, but we're seeing proliferation of mobile devices spread substantially. And so ultimately it allows for you to have an app on your mobile device. When you put the money in, it turns it into a digital form of money, which allows you to enter the banking system. And I think those are the types of solutions which are needed to be able to solve that particular example. Now, the example in which you have a paper check, that's different. I don't have a specific example of how that would be solved. Ultimately, conceivably, if you have a paper check, it's possible for you to you're likely living in a developed nation. It's possible for you to create a bank account. But the more extreme example, I think, is the one that I'm most excited about solving, which is how do you take cash and turn it into a form of digital currency that allows you to start participating.
Mm-hmm. There's another question here from Precious that says, sorry, my glasses are upstairs. Is the number of cryptocurrencies out there not troubling? In the future, how will humans carry out peer-to-peer transactions and still maintain universal monetary value?
Okay. So let's break this down. So number of currencies. Okay. Is the number of cryptocurrencies out there not troubling? It's troubling in the sense that it increases the confusion for people to enter the space. You can think of this as being like thousands and thousands of different experiments that are happening to try to see how to create new value. So it's a necessary component in order to be able to try to build a new financial system that has more access and more value accrued to individuals. So I don't think that it's troubling beyond the fact that it just increases confusion. And then the second part of the question is, in the future, how will humans carry out peer-to-peer transactions and still maintain universal monetary value?
I think they mean like if you hold, say, like a bucket of or a wallet of many different currencies, right? And they all fluctuate. How do you know what you have, and how do you translate that into, like, right now I can say I have this much money in the bank, and depending on like the Canadian dollar,
sure,
I can tell you what value I have. But
yeah,
if I have like 15 different coins in my crypto wallet,
yeah,
it's hard for me to say, can I buy X with this right now?
Well, I'd start answering this question with a question myself, is like, does our current system allow us to maintain universal monetary value? Inflation's at what, 7-8% right now in the United States. It's even worse in other countries. So if you're not earning that level of return, you're losing your purchasing power to that rate, which is substantial. So the reason why I'm not super concerned about the fact that we might have 15 different coins that are sitting in your wallet is the fact that there are going to be yield farmers or people who provide liquidity that allow for seamless exchange of those tokens into whatever you want to own. So if you want to own US dollar coin, which is a very high quality stable coin, or you want to turn that US dollar coin back into dollars in your bank account, that's pretty easy. So there's a lot of solutions being built out there that are going to allow for us to easily exchange whatever tokens we don't want to have for the ones we do want to have. And so I think it's important for us to just keep in mind that we're really early in this, and there's a lot of things that haven't been built yet, which are really important. But that doesn't prevent us from, just because something hasn't been built yet doesn't mean that we can't see a clear pathway towards it being built. And so I'm not concerned about, maintaining value across all these different tokens, assuming that there's products and services and yield farmers like me that are going out and actually providing liquidity and allowing for easy, seamless exchange of those tokens, again, into whatever you want to own.
Mm-hmm. So let's try to get to an end of this conversation through functional outputs. Right now, considering where everything is, like, the world markets are in turmoil, there appears to be some form of regression, stagnation, depression, stoppation, whatever. Like, something is happening in the world markets, just in general. Inflation is very high. At the same time, the crypto markets have taken a severe beating over the past month. Someone was commenting on how, like, in your course, you're referring to UST, but UST, since you recorded the course, things have happened with UST that are not good, right?
Yeah,
and that's
exactly.
part of, that's part of what this space is. So for anyone watching this right now, I have two core questions. One is, if a person sits here and goes, I want to go into this market. How do they make that, make a determination whether or not that is a responsible thing for them to do at this moment? And then second, if they actually do that, if they go in, how do they go into this market in a way that is as secure as possible to them? I'm not talking about the technological securing your data. I'm talking about like in a way that won't just result in all their money disappearing in a month.
Yeah. Well, again, going kind of back to the stablecoin discussion, there's certain stablecoins that are fiat collateralized, or essentially money in a bank account is backing it up, which I would call probably the least risky way to be able to try to enter the crypto market and earn yield. So you can create a MetaMask account, which is a decentralized wallet. Effectively, it's similar to like a wallet I have in my pocket. It's just I control my funds within my browser, and you can convert some money into USDC or any Paxos coins. So BUSD, GUSD, TUSD would all be, in my opinion, good potential coins to hold. And then you can go into the world of decentralized finance. And if you take if you go through my LinkedIn learning course, it'll explain more of this. But you can hold those assets and go and deposit them different places on the blockchain into smart contracts and begin earning yield. And in my opinion, that would be the simplest and safest way to start entering this particular market.
Right. And in your course, it was interesting to watch your course, because I've gone through the whole rigmarole of trying to figure out how to do like responsible financial investing and all that stuff. And when you go to a bank, they tell you, okay, here are your options, right? You have these hedge funds or whatever, and this is a low risk hedge fund with a low return, and then there's a medium risk and a high risk and an extremely high risk. And in your course, you go through the same thing. You say like, here's low risk, medium risk, high risk, and what you said, extremely high or like
extreme risk. Yeah,
extreme risk, which is the same as in the regular stock market, right? And so for people who want to get into this course is a great introduction, because you're actually providing the pieces you need to say like, this is the place you go, this is how you kind of analyze this stuff, and you have other course materials too that I'm sure dig deeper into this stuff. But let me rephrase my first question. There's this saying in investing that is something along the lines of, don't invest money you're not ready to lose.
Yes.
And I'm assuming that applies here too.
Of course. Yeah, absolutely. I mean, look, this is risky stuff. Like I can't emphasize that. This is very risky stuff. But I think it's really important technology that has that ultimately was going to disrupt not just the financial markets and how finance works, but ultimately how the economy works. And we didn't go too far into kind of Web3 stuff, but ultimately this is there is the potential for very high returns here, and there's a way for you to be able to access this and sort of choose your own adventure when it comes to the actual risks associated with operating in this space. And so kind of what I was proposing there in terms of holding high quality stable coins and earning yield in that way is probably the least risky approach, but it's still risky, right? I mean, there's all kinds of ways that things can go wrong. And so, yeah, I think always never invest more than you are prepared to lose is the right approach.
All right. One final question from one of our viewers. I think this is a good one to end on, actually. And it's asking for your opinion. So I want to take, like, you've been in the space for a long time. You have an opinion, and this is what we're asking for. Would you say that regulation will be detrimental to the crypto industry, or it is needed in order to allow wider adoption? Because there's a lot of, everyone is talking about regulation right now and what that's going to look like. So what's your opinion on that?
Look, I think it's it obviously depends on what the regulations are. I think that we have to have our regulations change. I mean, we're operating our regulatory environment when it comes to financial assets is from the 1930s, right? I mean, clearly the lot's changed since then. Clearly there's technology they couldn't even envision. And so trying to shoehorn this innovation into that regulatory structure is obviously not going to work long term. So I think that now that said, I think regulators understand that this is a very important technology, a very important opportunity for the United States, and I'm very hopeful that they will see it as such and come up with a regulatory structure that understands the nuances of this space and doesn't hinder our growth, doesn't hinder the innovation that's happening here. And ultimately, again, I firmly believe that this is the best opportunity for the average person to start closing the wealth gap, right? So to be able to start earning money in ways that we never, never previously had access to. And so it's why it's always dumbfounding when I see some of these politicians who are always talking about the plight of the average person, how they're getting screwed. And then in the next sentence, they're, attacking the one idea, the one industry that has any shot of trying to solve that problem. So it's dumbfounding. That's dumbfounding me. And it just shows that education is clearly very important in the space, and we need to push that and advance that. But yeah, I'd say, I'm optimistic. There's going to have to be regulation in some regard, clearly. But how it's done is really important. And I think there's some proposals out by certain lawmakers who get it, which I think would allow for us to not hinder innovation, but still allow for some guidelines, some guide rails. Ultimately, right, you can go and gamble, right? You can go gamble in most states on sporting events, but under current regulations, you're not able to access a lot of these financial products. And so I think proper disclosures are going to be critical. But yeah, it's to be determined. Undoubtedly, there's regulations coming, probably not until 2023, though. Given
there are other things happening too. Yeah, I think one of the interesting things when I talk to Web3 and crypto people is that regulation is framed as like a wet blanket on top of technology, but in many cases, the regulation is consumer protection, right? And I think it's important for the crypto community to acknowledge that most regulation is in place for consumer protection and actively pursue that avenue. Because what's happening is when regulation is removed, which is happening a lot in the United States, the consumer is the one that gets screwed, and the rich people get richer, and the big companies are able to just basically shift power away from people who aren't very, very wealthy. And when you look at countries that have heavy regulation, you have much less of a wage gap, you have much less inequity within the system because the regulations ensure that everyone is equally protected. So this is more like me imploring the people who work in the industry to actually look at what regulation is in other countries and how consumers are protected by regulation, and how removing regulations from the financial markets in the United States have caused this current situation and the current inequities to happen, because you can compare it to other countries who have higher levels of regulation and see how a lot of these inequities don't exist. So it's just something it's a proposal that regulation on its own is not a bad thing. It becomes a bad thing if it's done solely to hinder development of anything, or if it's done in a way that protects large asset classes but takes away power and protections from consumers.
Yeah, and it's obviously very nuanced, and it's going to be a balancing act in terms of how to do it well. It's not an easy problem to solve by any means, but if it's done well, and if good people are working in this space in DeFi and Web3, I think I think we do have the potential. It's not a guarantee, but the potential to actually build a system that uses economic forces in order to be able to distribute wealth more effectively throughout the economy. And that's, I think, what's most exciting about this. And it's tricky, right? It's by no means is this a slam dunk, right? It's going to take a lot of effort, a lot of work of people who really care.
Kedric, thank you very much for joining me in this conversation. It has been very informative. I can see from the chat on the side here that a lot of people are very interested in this topic. Like I said before, Kedric has a very interesting course on this topic, specifically around yield farming on LinkedIn Learning, as well as other courses. You can follow him on Twitter and here on LinkedIn and other places, and continue the conversation, because this is an emerging space that we all have a vested interest in seeing go somewhere. So thank you very much. Thank you all for joining us today. And if you are watching this and you go, hey, I have a question that I want to ask about something, this topic or something else, send me a message, send Kedric a message, send someone else a message and say, hey, let's discuss it. And I'll try to find an expert to talk about whatever it is you want to make sense of. Until next time, thank you very much for watching, and I'll see you in the future on the internet.
Thank you very much. Appreciate the opportunity.